The world is shifting faster than most people realize. For decades, the global economy revolved around a single axis, one currency dominating trade, investment, and policy decisions. It created a sense of safety, of predictability. But what appeared to be stability was, in many ways, concentration, risk disguised as order. When we rely too heavily on a single currency, we hand over control of value, liquidity, and leverage to forces outside our own making. And history teaches us that concentration, in any form, whether in portfolios, in technologies, or in currencies, eventually breeds fragility. We're entering an era defined by decentralization, in technology, in finance, and increasingly in global power. The unipolar world of money is beginning to fracture, not out of chaos but out of evolution. Nations, corporations, and individuals are seeking resilience. They are asking what happens if the system we've trusted begins to shift beneath our feet. The answer is diversification, not in assets alone, but in the very foundation of how we store and measure value. Currencies are, at their core, reflections of confidence. When trust consolidates around one, it grows powerful. But as that trust disperses, alternatives begin to thrive. We are seeing this play out right now. Digital assets, commodity-backed trade agreements, and new regional payment systems are emerging. They may seem small compared to the dominance of a single global reserve currency today, but so did the internet when it first appeared, and yet it rewired everything. Innovation always finds a way to challenge the old order, and money is no exception. We're witnessing a quiet revolution, a shift from centralized control toward network-based trust. It's not about replacing one currency with another. It's about embracing a system where multiple forms of value coexist, compete, and reinforce one another. That's how resilience is built. Think of it as an ecosystem. A healthy ecosystem doesn't rely on a single species. Diversity is what sustains balance. Similarly, a global economy grounded in multiple currencies, each with different strengths, policies, and underlying technologies, will be more adaptive to shocks. It will reduce the contagion risk that comes from overdependence on one financial pillar. This shift won't happen overnight. Change never does. But the signals are there. Central banks diversifying reserves, emerging markets settling trade in local currencies, corporations experimenting with blockchain settlements. These are not anomalies. They are early indicators of a new paradigm taking shape. For investors and innovators, this is a call to prepare, not to fear. Because when the monetary landscape evolves, opportunities expand. Those who anticipate change before it becomes obvious are the ones who benefit most. The challenge is to think beyond the comfort of what has always worked. The real question isn't whether the global monetary order will change. It's how ready we are when it does. So as we navigate the next decade, let's look through a lens of adaptability. Let's question assumptions that have held for generations. Don't rely on one currency, one model, or one system. The future rewards flexibility. The most powerful trend in history has always been human innovation, and innovation doesn't rely on one source of value, it creates new ones. In times of uncertainty, there's one principle that stands the test of every market cycle. Own what's real. Not what's promised, not what's artificially inflated, but what has substance, scarcity, and enduring value. For too long, the world has placed faith in abstractions, paper assets, digital entries, theoretical valuations. But when volatility rises, when trust in systems wavers, the market begins to reprice reality. Tangible assets, energy, land, innovation platforms, intellectual property, productive capacity, regain their true worth. Owning real things is not about nostalgia for the past, it's about clarity for the future. We are living in a world being rebuilt from the ground up. Supply chains are being restructured, industries are being digitized, and economies are redefining what value truly means. In such an environment, those who anchor their portfolios, their businesses, or even their mindset in real, foundational assets will not only survive the transition, they will lead it. There's a profound shift taking place. Value creation is moving closer to what is verifiable, measurable, and usable. The excess liquidity of the last decade allowed speculation to flourish, capital chased growth stories detached from productivity. But cycles of speculation always end the same way: reality reasserts itself. That's when the importance of owning what's real becomes clear. What's real can take many forms. It could be advanced manufacturing, the ability to build rather than just design. It could be intellectual property that powers artificial intelligence or biotechnology. It could be energy infrastructure or even natural resources that underpin new technologies. Real value comes from things that create, enable, or secure the future. These are the assets that will define the next generation of wealth creation. When you look at innovation through this lens, it's not about owning a stock. It's about owning part of a platform that's transforming how the world operates. Real things don't just sit idle, they compound. They create utility, they sustain demand through multiple cycles because they solve real problems. The last decade rewarded narratives. The next will reward substance. That doesn't mean abandoning technology or future-oriented assets. It means grounding them in utility. The companies, nations, and individuals who control real production, real data, real energy, and real intellectual property will become the new anchors of global growth. Every cycle brings a reckoning, and this one is no different. Monetary systems are shifting, digital networks are decentralizing, and inflationary pressures are reminding us of the limits of financial engineering. In this new era, real assets aren't just a hedge, they're the foundation of resilience. So think long term. Ask what will hold value when sentiment fades. Ask what can endure disruption and still produce, generate, or create. The answer will always point back to what's real. Because while markets fluctuate, while narratives rise and fall, reality compounds quietly in the background, and those who own it are the ones who ultimately define the future. True protection doesn't come from prediction, it comes from preparation. Markets move in cycles, economies evolve, and technology rewrites the rules faster than anyone expects. In that kind of world, concentration isn't courage, it's exposure. Diversification is not just a financial strategy, it's a mindset. It's the discipline of acknowledging that no single sector, currency, or idea holds the monopoly on truth forever. For years, investors were conditioned to believe that focus drives returns. And yes, conviction matters. But conviction without flexibility becomes fragility. The greatest strength lies in the ability to adapt, to build exposure across ideas, geographies, and time horizons that complement each other. Because every era has its winners, but no era has only one. The most transformative opportunities often come from the edges, places the consensus overlooks. Innovation rarely emerges from where the capital already is, it comes from where the next wave is forming. Diversification gives you the optionality to be early without being reckless, to participate in breakthroughs without betting the entire future on a single outcome. We are living through a time of profound transition. Monetary systems are shifting, technology is accelerating, and policy is redefining the structure of global trade. In this kind of environment, protection isn't about hiding in cash or clinging to the familiar. It's about broadening your exposure to the new frontiers of value creation. Renewable energy, artificial intelligence, robotics, biotechnology, next-generation infrastructure. Each of these represents a different form of innovation, and together, they build a more resilient foundation. Diversification also protects against the blind spots of human bias. We tend to overestimate the durability of what's worked and underestimate the potential of what's emerging. That's how investors miss paradigm shifts. But by distributing exposure across multiple themes, you allow the future to reveal itself, not through prediction but through participation. There will always be noise, volatility, and moments of doubt, but when your portfolio, your strategy, or even your thinking is diversified, volatility becomes opportunity. You're not forced to react emotionally to every shock, because you're not overexposed to any single point of failure. You have the flexibility to lean into strength and let time compound your patience. True diversification isn't about owning a little bit of everything, it's about owning different sources of growth and protection that behave independently. It's about balancing innovation with stability, growth with preservation, ambition with discipline. It's the only free form of risk management the market offers. and it rewards those who practice it with both resilience and optionality. So as the world enters this next cycle, defined by disruption, decentralization, and discovery, remember this: concentration may deliver excitement, but diversification delivers endurance. The future will not belong to those who bet everything on one outcome, it will belong to those who prepare for many. In a world that's constantly evolving, diversification isn't just protection. It's survival, and ultimately, it's freedom. Every generation believes its moment is unique, but in truth, the rhythm of progress always follows long-term cycles. Markets rise and fall, technologies mature and reset, and societies adapt to new paradigms. Yet in the midst of every short-term fluctuation, most people forget that the real gains, the transformative, compounding ones, belong to those who think beyond the immediate noise. Long-term cycles are where true value is created, not through reaction but through vision. When we study history, patterns emerge. Innovation accelerates productivity, productivity reshapes economies, and then a correction redistributes capital to the next wave of growth. These aren't random events. They are the natural breathing of economic evolution. The problem is that short-term thinking compresses perspective. It blinds us to how the present fits into a broader continuum of change. We are living through one of those transitions right now. A structural shift from the old economy to the new. Technologies that were once dismissed as speculative are now redefining industries. Artificial intelligence, energy storage, robotics, and genomics are reshaping cost structures, increasing efficiency, and unlocking new frontiers of possibility. These are not quarterly stories, they are decade-long arcs. And those who position themselves with patience and conviction will ride the full compounding power of these trends. Thinking long-term is not about ignoring risk, it's about understanding it differently. Short-term volatility is a reflection of emotion, fear and euphoria fighting for dominance. But long-term cycles move according to fundamentals, innovation, adoption, and productivity gains. When you focus on those drivers, temporary dislocations become opportunities rather than threats. The market may oscillate, but the trajectory of human progress remains upward. The greatest investors and innovators have always shared one trait: time horizon. They look where the world is going, not where it has been. They understand that exponential change looks linear at first, until it suddenly isn't. That inflection point is where the impatient exit and the visionary begin to build. Every great cycle rewards those who endure through its early uncertainty. Patience, in this sense, isn't passive, it's strategic. It's the decision to align with inevitable trends and allow compounding to do its work. It's choosing to understand the deeper forces, technological breakthroughs, demographic shifts, capital reallocation, and letting them unfold. The most powerful gains don't come from chasing momentum, but from staying positioned while the world catches up. Cycles teach humility. They remind us that no phase lasts forever, and that optimism, when grounded in data and innovation, outlasts every downturn. The key is not to time the peaks and troughs, but to recognize the direction of transformation and stay aligned with it. So think beyond this week, this quarter, this year. Think in decades. The real story of progress has always belonged to those who could see through the noise and trust the cycle. Because the future doesn't reward the fastest reaction. It rewards the longest conviction.